Good morning, everyone. Since the time is short, I'm just going to get to the point directly that we are going to answer basically two questions. What is the future of shale in 2021 and after? So when many of you who attended today, basically you've seen those charts regarding the prices. And just to point out what happened to shale this year, if you look at the left, you have Brent prices, that's 2020 versus 2019. On the right, you have WTI, and that's again 2020 versus 2019. Notice that WTI went negative on April 20th, while Brent did not go negative. WTI went negative simply because of the specifications of the contract itself. There is no time to explain it for those who are not aware of it. But the whole idea here is this decline was contract specific. There were many factors, of course, that lowered prices, but going negative was contract specific. And that has a tremendous impact on shale that, unlike anything we've seen before, and I will show you the impact once we get to the production, how the impact is different from any other price drop in the past. This chart shows US production in 2020 versus 2019. The decline in December relative to December 2019 is 1.76 million barrels a day. But really, the impact should be compared to what was expected at the end of 2019 from the end of 2020. And you can see that the impact is huge. It's 2.6 million. So the first conclusion here is the impact of lower prices from COVID and everything else on shale is huge, is larger than even the production of some OPEC members. Percentage-wise, it goes along with OPEC cut when OPEC Plus decided to cut 9.7 million barrels, which is about 23%. So in a sense, US producers, although legally they cannot participate in any cut, they did cut production. So they closed wells and they did cut production. Looking at the rig count, and this is only in major tight plays since we are talking about shale, you can see the major drop here. That's where, when we started in March with the Russian-Saudi dispute, and then it's followed by the impact of COVID, and you can see that it's a major decline. Since we are talking about the future of shale, notice that the oil rig count improved, and we kind of seen an increase, but this increase is really minor relative to what we had in the past and what is needed to maintain production. Looking at rig count by basin versus oil prices, you can see that the major drop happened in the Permian. And as prices increased, and I'm looking here at the right side of the chart, as prices increased, we've seen improvement in the Permian right here on the right side. So most of the activities basically were in the Permian. Most of the drop happened in the Permian, and the increase happened in the Permian. But we got to be careful here when we look at this chart. I would like you to look at the left side of it and at the right side of it. At the left side, we have the impact of the price drop in 15 and 16. At the right side here, we have the impact of the price drop in 2020. The first observation is the drop in 2020 is sudden and steep. And the recovery, the beginning of the recovery is almost the same. But the major difference here is we have US elections. And if you look at the details of the rig count in the Permian, you will see more activities here in the part of the Permian that is located in New Mexico relative to this one here. Yes, it is true that that part of southeast New Mexico is really rich and better than West Texas, and the wells productivity is higher. That's absolutely correct. But there is another difference, that most of it is federal land, while everything in West Texas is owned privately. So this increase here may not all of it is price related. Some of that basically is to kind of drill preemptively before Biden ban fracking on federal land. So some of this increase in rig count here is not related to prices. By the way, for those who are interested, there is a video, a short video, about 2-minute video showing the relationship between plays and oil prices. This is the link. You don't have to copy the link, but you can look for the title, The Dance, the rig count by basin versus oil prices on YouTube. And it's very interesting dynamic on the relationship between oil prices and the rig count. And I'm going to post that on my Twitter account too after we finish today. This is the frac spread from our friends at Primary Vision. It is, we know, because of the major improvement in productivity in recent years, that the rig count is not it does not predict production anymore. It's one of the factors that predict production. But frac spread and well completion does. And it is very important to follow those variables. And if you look at frac spread, just like the rig count, it dropped like a rock in April and May. We've seen some recovery, but it's not enough to maintain production. That's why we see a decline in production in 2021 in US Shale. We need this frac spread to go up to close to 400 to see production picking up substantially. Again, I'm going quickly, simply I have 10 minutes. Looking at crude production by basin, and you can see what happened in April here as a result of the sharp drop in oil prices and that negative pricing. We have just a major drop. What makes this drop different from this drop here in 2015 and 16 is that this is gradual, this is a sharp drop. And the reason why, because here we just let wells basically kind of continue to produce, and the decline rate will take care of it. Here we have major shut-ins. And that's why we see a major drop and a major recovery too. You can see that V recovery here simply because we shut in wells and then we open them later. This decline here, basically, that's the expected result as because of decline in investment, decline in rig count, decline in well completion, while we have major decline rates or very high decline rates in those wells. So we've seen this decline. This decline is expected to continue to 2021. The other irony here is, look at the drop in production versus the drop in prices. You can see that almost perfect correlation. We did not see that in history simply because of the shut-ins. So what's different this time is the shut-ins. So what are the major issues? I cannot discuss all those issues here, but I'm going to talk about cost and productivity, debt, mergers, etc., and crude quality. I don't think I'm going to be able to cover all of those, but let me go over the first one. This is an old chart I made. It is on I will post it again on my Twitter account if you cannot read it. What happened after 2016? After 2016, we've seen major improvement in costs. We've seen major improvement in efficiency and productivity. Or supposedly, we've seen major improvement in efficiency. That's not the case. The reason why we've seen major improvement after 2016 is that companies were producing all over the place, including very expensive areas where the X is, for example. What you see here on the chart, this is the cost curve. So on the side here, or the axis on the left is the cost, and then the horizontal is the production. and this is the supply curve or the cost curve. So they were operating at X. When prices dropped from almost $100 to the 30s in 2015, companies continued to drill everywhere and they discovered the core. So they moved from X to Y. That's the core of the core. So it was about location. Most of the drop in cost about location, and that location brought in more production, and therefore we've seen higher productivity. Any improvement in efficiency will shift the curve down. So in a sense, what we did is we moved from X to Y, and then we moved to M. Y to M, basically, that's the only efficiency that we gained either from management efficiency or other efficiencies. So the improvement in efficiency was very small, but we were able to increase production continuously between 2016 and 2019, and with higher productivity simply because of location. Now comes 2021. We have low prices, we have recovery. The problem is there is no core to move to anymore. So we cannot move from Y to another one on the left that is far away as far of X to Y. And therefore, we cannot replicate the experience of 2016, 2019 to what we have right now. Yes, $60 and $70 oil is going to increase shale production. Yes, it is going to, we are going to see another growth, but not as much as before, simply because we already reached the core and there is no other core to move to like we did in 2016 and 2017. Companies are bragging about decline in cost. The fact is, I'm not going to name this company, but this is taken from the financial statement in a quarterly financial statement, and they are showing a major decline in cost in 2020. Per well, it's 1.8 million saving just per well between the original planning at the end of 2019 and the second quarter. That's significant cost decline. But if you look at the fine print, what they are saying basically is the result of increased efficiencies. Well, that's price related. And service cost deflation, that's price related. They expect 60% of well cost saving to be sustainable. Well, what they did not say here is at the prices of the second quarter, which we know it was very low. Today's prices are more than double those prices. So the idea here is no, cost is not going to decline at $70 or $60 or $70 oil. Cost will go back to where it was in 2019. Simply, the cost was because of the service, because of the land, because they laid off workers, etc. I'm going to just share some information on where the cost is coming from.
Dr. Nas, as we're getting close on time, we'd like to transition.
One minute, I will finish.
Okay, perfect.
Okay. So there are various reasons why we have those declines. I will post this on Twitter too, so people can read it. As you can see, all of those are reversible. The other issue that will limit shale is crude quality. Shale is light crude and condensates. We don't have enough refining capacity if it's going to grow like the IEA predicted. At the same time, those refiners are not going to invest enough to handle that shale because quality is a demand issue, is not a supply issue. Therefore, when we look at the future demand, it's mostly for heavier products. And that leads us to one of the main, and that's my last slide. The main conclusion here is shale production will have multiple peaks in the coming years, but we are not going to replicate the experience we have in 2016, 2019. Shale growth, its own enemy, because at certain level, crude quality will limit its growth. And this is really the main point today is if IEA and OPEC forecasts are underestimating demand or electric vehicles do not deliver the expected growth, shale will come to the rescue simply because the fastest way to bring oil online to meet demand is shale. Crude quality matters. Thank you.
Thank you, Dr. Anas. I believe we have some time for maybe one or two questions. If anyone would like to post one in the chat box, we can try to answer it before we have to close out. I just wanted to start with an overarching question. Of course, by altering demand dynamics for the foreseeable future, has the COVID-19 pandemic dealt a permanent blow to higher cost producers such as shale?
Not really. I think one of the shale is one of the most or the least understood issues in the oil industry. To give you an example, even when prices were extremely low, we had 180 rigs running. 180 rigs.
Wow. We have also a question from Victor in the chat, looking to see if you expect demand for heavy crude to increase.
Yes, and it will continue to increase for in the next, at least for the forecast period to 2050. It will continue to increase for various reasons, especially we have tremendous demand for trucking in Asia and Africa. Don't expect electricity basically to be the main source in places like Ethiopia and Somalia or Tanzania or other places or Kenya. With all due respect to those countries, of course, I'm not trying to put them down at all. But the whole idea is as they grow, we have to remember that those people want exactly what the Europeans and the Americans have.
And then more of a finance question. How will U.S. producers, do you think, win back Wall Street financiers? Do you think there'd have to be a new deal structure?
Well, not really. I think we already went through various deals and various methods, etc. We already have seen companies basically through the mergers that they went through trying to improve their balance sheet so they can win financing back. But we got to remember that we have private equity is just waiting to attack, and probably at this time we have about $80 billion just parked on the side. So even if banks do not act, private equity is going to jump.
I think we have time for one more question. What oil price level, if any, do you think would bring a full U.S. shale recovery back in 2021?
Generally speaking, because some of that shale basically is priced off Louisiana Light and others like Brent. So even regardless of WTI, if Brent is above 60, it will bring growth. But again, the growth is not going to be similar to, even at 80 and 90, the growth is not going to be similar to what we experienced in 2016 to 2019.
Well, thank you very much, Dr. Anas. Before I give it to you for just a final comment, just want to let the audience know that, of course, this is being streamed on LinkedIn right now and across social media and the Bloomberg terminals. You'll be able to go into social media as well after and see the recording of this session. Dr. Anas, any final comments or any final points that you'd like to make?
Yes. The question is, does OPEC or OPEC Plus want to kill shale? No. Does Saudi Arabia wants to kill shale? No. Do they want to kill shale growth? No. Then what they want? They want shale to grow they want shale to take partial growth of total demand. They don't want shale to take the whole growth in demand as it did in the past. They benefit from the existence of shale.
Well, thank you very much for your insights, Dr. Anas. And we'll also have those who are attending check out your Twitter, as you said, for what you'll be posting following this. Thank you, everyone, for attending, and we look forward to engaging again soon.